Life is just, well, it's full of uncertainty, isn't it? From our health to our homes, we are constantly facing the unknown. It's this fundamental human challenge. So, what's the big idea humanity came up with to deal with it all? And that really boils down to this one crucial question. How do we deal with an uncertain future? I mean, how do we protect ourselves and our families from those financial shocks that can literally come out of nowhere?
Think about it. It can happen in just an instant. A car accident on the way to work.
Or a fire that threatens a home, maybe a factory that someone spent a lifetime building.
Or the sudden, absolutely irreplaceable loss of a family's main provider. I mean, these kinds of events, they can be completely financially devastating. We're talking about an overwhelming, life-changing loss.
All right, so this brings us to our first big idea here. We all live in a world that is just packed with risk. It doesn't matter if you own a car, a house, a business, or if you just rely on your ability to get up and go to work every day. You're exposed to these potential financial dangers that, let's be honest, are mostly outside of your control. And just think about it for a second. A road accident, a ship sinking out at sea, that factory fire we mentioned. These aren't just personal tragedies. They create massive financial distress. And it's that constant worry, that's the problem we're really trying to solve here. So, okay, we're faced with all this uncertainty, all this risk. What did we do? What was the solution? Well, we came up with a pretty brilliant cooperative solution, and that is the big idea of insurance. And just so you know where we're getting our information for this discussion, our whole explainer today is grounded in a textbook on insurance and risk management from the Bangladesh Open University. Okay, so what is insurance, really, like at its absolute core? The key word to focus on here is cooperative. This isn't some kind of magic trick, it's actually a really simple system. It's where the potential catastrophic loss of just one person is shared. It's spread out and covered by the small contributions of many people. It's a group effort. So how does this actually work in practice? Well, the mechanics are surprisingly straightforward. Let's break it down. Step 1. You identify a risk you have. Let's stick with the car crash example. You then transfer the financial part of that risk to an insurance company. Step 2. The company says, okay, we'll take on that risk. They're promising to pay you a big chunk of money if that bad thing actually happens. And finally, step 3. In exchange for that big promise, you pay them a small, manageable fee on a regular basis. And that little fee? That's what we call the premium. But, and this is really important, you gotta understand that this whole thing is a two-way street. Both you and the insurance company have totally different goals, different motivations for getting into this contract in the first place. So, for you, the person getting insured, your goal is pretty personal, right? You want financial security. You want peace of mind. But for the company, the insurer, their objectives are all business. They're in it to earn a profit. And by pooling all those premiums from thousands of people, they build up these huge amounts of money, or capital. Now, this whole process, paying money based on chance, it can lead to a really big misunderstanding. So let's tackle a question that comes up all the time. Is insurance just a form of gambling? I mean, you're basically betting that something bad is going to happen, and the company is betting that it won't, right? Well, actually, it's not that simple. It's not right at all, in fact. Okay, this is the crucial point, so listen up. Insurance and gambling are actually complete opposites. Insurance is a tool to manage a risk that already exists. You already own the car, so the risk of a crash is already there, whether you have insurance or not. Insurance just helps you reduce the financial fallout. Gambling, on the other hand, creates a brand new, totally unnecessary risk where there wasn't one before. It's the difference between wearing a seatbelt and jumping out of a plane without a parachute. One manages risk, the other creates it from thin air. And look, this distinction is absolutely vital because when you step back and look at the bigger picture, you start to see that insurance isn't just some personal financial product. No way. It's a fundamental pillar of our entire modern economy. So remember that giant pool of money, all those premiums we talked about? Well, it doesn't just sit there. It gets invested right back into the economy. We're talking about money that funds everything from new bridges and hospitals to the next big tech startup. Think about it. Insurance gives people the confidence to go out and start businesses because they know they have a safety net if things go wrong. And on a bigger scale, it creates social stability. It helps families and entire companies get back on their feet after disasters that would otherwise completely crush them. Which really leaves us with one final, powerful question to think about. Without this core idea, this simple concept of sharing risk, Would our modern world even be possible? Seriously, could we build skyscrapers? Could we ship goods all across the oceans? Could we launch huge new companies if every single person and every single business had to bear the full, crushing weight of every potential catastrophe all by themselves? Probably not. It's that simple act of sharing the burden of an uncertain world that's what allows all of us to dare, to build, and to move forward.